Welcome to the Unit Economics Podcast. I'm Josh Stavinsky. On today's episode, I sit down with Dan Graham and Mollye Santulli of Springdale Ventures. Springdale invests in early-stage consumer brands, and I wanted to use this conversation to understand how the investing side of the industry actually works. In this conversation, we walk through the entire life cycle of a deal, from how a company first gets on their radar to the metrics they look at, how they evaluate founders, how they think about valuation, and what can ultimately cause them to pass. We also get into portfolio construction, follow-on investing, how they underwrite, and what their role looks like after the check is written. I learned a lot during my conversation with Mollye and Dan, and I hope you enjoy it as much as I did. Dan and Mollye, thank you both so much for taking the time to do this today. If you wouldn't mind just starting with a background on yourselves, that would be great.
Go for it, Mollye.
Sure. I'll kick things off. I'm excited to be here. I'm Mollye Santulli. I'm a principal at Springdale Ventures, where I work for Dan, who's joining us today, and Genevieve, the other partner and GP at Springdale. Before joining Springdale almost 4 years ago, I worked for Simple Mills and General Mills before that in corporate finance, and did a brief stint at RX Bar in college, which is what got me super excited about the CPG world. Since joining Springdale during business school, I've really enjoyed being on the investor side of things, and have had a blast learning from Genevieve and Dan.
And I'm Dan Graham. I'm one of the general partners, co-founder at Springdale Ventures. My background started out more entrepreneur turned investor. So I was a student at the University of Texas, originally studying computer science and philosophy, and then in law school when I started a business in the custom printing space, a business called Build a Sign that sold everything from t-shirts to home decor wall art, signage, bumper stickers, business cards. Bootstrapped that business for about 10 years before selling it to Vistaprint in 2018. And out of that transaction, started to do a lot of investing, saw an opportunity with Genevieve in the early consumer brand stage, kind of seed to A, to provide capital to great founders, and have been doing that ever since.
Yeah, can you touch a little bit more on what gap you saw in the space? I've heard you in other interviews allude to this sort of financing gap that existed, particularly among brands in like the, roughly like $1 million run rate range. So could you just elaborate a little bit more on what you were seeing in the market?
Yeah, absolutely. So when you think about a CPG or a consumer brand who is going from 0 to 1, most of those brands need to raise capital right out of the gate in order to do some brand work, maybe packaging, maybe an initial inventory run so they can do some demos to try to get their first sales going. And so they typically will do that without any real customer data yet. And there's a pre-revenue raise, and that typically is an angel round where they're going out to friends, family, people within their network, usually raising money, $25,000, $50,000 checks at a time, typically on an instrument called a safe note or a convertible note. And they're cobbling together $500,000 maybe for that round. And then as they grow and they start to get real traction and the purchase orders get larger and they need real capital to grow the business, they then have to typically go do another round of funding. And at that stage, they need $1 to $2 million. And that tends to be a lot harder, actually. And that really is the point at which we were noticing the gap, where at $1 to $2 million, going and raising money from angels at $25,000 or $50,000 at a time takes a lot of energy and a lot of time to do that, and it's really hard. And also, you've often already gone to friends and family at that point. And the big funds out there and most of the capital that deploys into consumer brands are larger venture capital or private equity who won't write $1 million checks. Because of their size, they've got to write $3, $5 million plus dollar checks, since that's like your Catterton or BMG or Cavu or Asto or those kinds of funds. And so as a result, these businesses that are starting to take off and have really strong early traction and metrics and really promising margins and just outstanding results to look at struggle to raise money. And it's not their fault. It's just the way that the capital is divided across, or I should say, like it splits between kind of the angel round and then the later stage VC. And so that's the gap that we saw, was providing capital at that moment in time where there's a lot of data, from the companies, a lot of traction to look at, and yet very little capital.
For listeners who aren't familiar, I have a fairly, I would say, diverse audience base. There are folks in the CPG space who are really familiar with what you're talking about. There are other investors listening, operators, my dad. So for folks who are not as familiar with how this all works, I'd love to walk through the life cycle of a deal and first sort of understand how a company gets on your radar. If you can share what the split between conversations that you're actually sourcing versus what's coming inbound, what does it look like from the onset when we think about the actual life cycle of a deal?
So we see, high level, we see about 1,000 deals a year at Springdale, which is a lot. And we are very lucky that a lot of those come in to us rather than us sourcing them through both our network and through cold outreach. So whether that's on our website, through the form on our website, or just people sending us emails. And so I'd say about 50% are cold inbound to us. The other 50% are either through other investors. So like Dan was talking about, those later stage funds that can't write small enough checks to invest at our stage. We get a lot of deals from our friendly network of later stage investors, as well as our peer investors who might not be filling around and want us to co-invest with them. And then our LPs that are in our fund, they send us deals, as well as founders in our portfolio, and then founders we just know. And so we love to get inbound from a founder maybe that we've met telling us about another founder. That's always really fun because the founder ecosystem supporting each other is a place where we get really excited to see deals that come from operators themselves. And then on the sourcing question, I always joke my sourcing time is usually when I'm on my couch and scrolling on TikTok and see a company I haven't heard of yet. So we do some cold, outreach to founders that we see on LinkedIn, or we see, press about a company, see something on Instagram. But a lot of our deals come inbound, which is great. And we hope that, the more things like this we do, the more inbound deals we get. And so we're always thinking about expanding our ecosystem to make sure that we're getting access and seeing the most deals and meeting the most founders, attending events, going to trade shows, all of those activities. And so on the deal side of things, what that looks like then, a company comes into our inbox somehow, whether it's through our own outreach or through our network. And we review the deck, and if it meets some of our criteria, which are, that million in trailing 12-month revenue, it's a category we invest in CPG, branded products. And we think the brand looks interesting, whether that's from a category perspective, the founder's background, whatever that might be. We do a first call, and a lot of times that's with me. And then if we continue to be interested, we discuss as a team and get Genevieve and Dan on the phone, and then move through our diligence process.
So walk me through what you're looking for on that first call. What's the sort of filtration mechanism to pass somebody from that first call to actually get deeper into the diligence process?
I am often the filter. I feel like my job is being a filter a lot of the time. So the revenue threshold is probably the main one, and we meet a lot of amazing founders who are super early in in building their company. And so we love to do those calls. A lot of times, I do calls with founders that are below that million in revenue. But, for the most part, we are looking for that traction that Dan talked about. And so for the most part, revenue is a major barrier for a lot of the calls in terms of I just pass via email because I say this company isn't at the right stage for us. Then the things that get us excited on the call, founder background and founder market fit. So, does the founder have experience in consumer? That's super exciting. Is this their second company? Do they have some unique problem that they're solving for themselves and they know the category really well? On the category side, is this a big category? Is it a growing category? Is it, a trend? Not necessarily a trend, but, something that we're excited about right now, whether that's protein or fiber or whatever that might be. And then I'd say the last thing is that on that traction, what do the financials look like? And so how are the margins? How close to positive contribution margin is the business? We can get into the weeds on finance stuff that we care about, but we have a bunch of metrics that we spend time looking at for direct to consumer businesses, as well as retail businesses. And so it's a lot of different things that have to all kind of make sense. But I would say the main filter is traction and the unit economics of the business.
Yeah, you sort of teed up my next question, which is around what metrics you really try to focus on specifically. So let's say I come to you and I have a $2 million pretzel brand. What are the first couple metrics you're going to look at? And if you could only look at one, what would it be?
Probably contribution margin, fully loaded contribution margin, which we look at contribution margin with, so your gross product margin, and then, all of your freight and fulfillment logistics and your paid marketing. I mean, for pretzel business, it might not have a huge direct consumer business. So maybe it's just trade spend is where most of the marketing is. But, how much are you making on each unit of product that you sell? And what is the path to that being a sustainable level to cover your fixed costs look like?
I think it's kind of a tough question to pick one number just because, I mean, you can have great unit economics if you never sell anything. And so I think where really the rubber hits the road is on, are you growing while maintaining good contribution margins? I think like in a very general sense, rather than a particular metric, what we're trying to figure out is whether there are levers on the business that will allow it to scale profitably. And so that could mean different metrics depending on the type of business that it is. It could speak to the channel, it could speak to geography, it could speak to the unit economics or the growth rate. It depends a little bit, or even sometimes like another example is you could have really great growth with great contribution margins, but if you're an influencer who launched a brand, well, is there room to grow beyond just marketing to your own follower network? Or have you tapped that out, and right at the moment you tapped it out, you went to go raise money, and that's why your chart looks so good at the moment. And so just really trying to figure that out is, I think, the broader way to state what we're looking for.
And then from a qualitative standpoint, what matters most when you're talking about the sort of attributes that, a founder might bring to the table? And how do you actually tease that out? How do you sort of pressure test that? That seems like a really difficult thing to assess.
The percent of deals that we look at where, at least in the conversations that we have, the founder seems like an amazing leader who's going to run through walls to make the business successful, has the right kind of combination of ability to sell, ability to fundraise, ability to manage the financials of the business. So I mean that is a strong filter already. And then with the remaining opportunities left in that, trying to figure out like, okay, but who's actually going to do a great job? And how do you pressure test that? It's definitely a hard question to answer. Sometimes it's a repeat founder, but usually not. Sometimes you can get information from some references, but not always. And so I think there does come a moment where you're making a judgment call based off just perspective and how it seems and how it feels based on all the conversations that you've had. But that final cohort of potential founders to back, that does get filtered way down, and there are a lot of people who kind of opt themselves out along the way for sure. And so it's not like, I think, if we're looking at 1,000 deals, we see 1,000 backable founders in that way that you're talking about. And so it does winnow down pretty readily, I think.
Yeah. So out of the 1,000, if you had to ballpark it, how many do you think fall into that category?
I think I would say, Mollye, you might have a better sense of this just because you're closer to the top of the funnel, but I would think 5 to 10% or something like that, where founders are pretty impressive at first, on the first call.
Yeah, I think that sounds about right. I think one of the other things that Genevieve and Dan have talked to me about in terms of quick, if there are ways that we try to think about founder qualities, one of them is, do we believe they can hire a team? And how do they interact with both us on calls as investors, but also do we know if they've hired people in the past? Are people excited to work for them? And that's sometimes hard with super early stage brands, but I think a testament to, how they're going to be able to scale their business is are they going to be able to delegate and also bring in amazing people to work with them? So that's something, just one quality that I spend some time trying to think about, even if it's hard at the early stages.
I do think that tends to be where most investors encounter challenges giving feedback. I think it's easy to say, oh, your growth rate's not high enough, or your margins aren't big enough, or something like that. It's much harder to say, something that feels more personal around, like, oh, your handle of the financials seems weak, or something like that. And so I think there's a gap just in terms of like transparency and communication that happens between investors and founders at those moments when you're trying to evaluate more of the qualitative aspects of the opportunity.
Yeah, that makes sense. Once you get to the end of the diligence process, what can you look past and what can you not? I assume there's some companies that you speak with where you're like, man, this seems really compelling, but there's this one thing. And so I'm wondering if there's anything that you, I don't know, see come up more regularly, any sort of trends there, any patterns around like specific hangups that come up?
I mean, I think there are calls that are easy, like occasionally we'll find out something late in the process that they weren't disclosing. Maybe it's debt, or maybe it's something that we just feel like they should have been more open about, and then we suddenly feel like they were hiding something. So aspects around trust are huge. So there are things like that I think draw pretty bright lines. I think where it gets harder is when it's a great business and everything looks good, but we're not completely certain on the market for exit. How many buyers are there for a business like that, especially if it's in a new category, and that's where it's harder. I mean, there are a lot of things that can call a deal into question as we're going through and learning and doing our own research on the back end. And I think with the number of deals that we see, kind of part of the strategy is looking for reasons to say no. I mean, in a very, I think, high level sense, the founders in sales mode and on their, presenting in the best possible light. And so we're a little bit trying to read between the lines and think about the things that aren't being presented. And so, that's just generally a challenging position to be in.
One other example that usually comes out not at the very end, but is something that can prevent deals from happening, besides I think the exit point that Dan made is a great one, but cap table dynamics, and what does founder equity look like, and who owns which pieces of the business, how much of the business has already been given up to advisors or to, early investors versus the new investors, and what will, the equity pool look like for future employees. And that can get really messy really quickly, depending on safe rounds before our investment, or, stacked notes, or there's a lot of complicated things that can happen even at the earliest stages. And so I would say that's an area where we end up spending a lot of time and trying to both, understand for ourselves what it means for our investment, but also hopefully making things easier for the founder to understand, because it can get really complicated. And in the end, like, we want founders to own a good portion of their business, because then they're incentivized to scale and they have the best outcome. And so that's a place where we spend a lot of time that can get somewhat complicated and messy throughout the diligence process.
It's surprisingly not that uncommon to have a founder with single digit ownership. And when we push back and say, hey, let's go talk to your investors and come up with a better percentage for you, that the investors will come back and say, no, we'll take care of them at the end. And the founder is kind of in a weird spot because they're trying to fundraise, and that happens more and more than you might think. And it's a big, we see that as a big risk to the success of the business.
Yeah, single digit ownership at the stage you're investing at really surprises me. That's not what I would have expected.
Yeah, usually that comes about when you have someone who has, say, the money, and they effectively put the company together, and then they hire in as their like founder CEO, someone to come in and run it. And so the founder comes in and signs a deal of like, oh yeah, I'll come in as the founder CEO with 10%. And they just don't think about it, and because they were sort of like brought in by someone. And that's the most, I would say, like typical way we see that coming about.
Yeah, that makes sense. And then how do you think about valuations generally? How often do you get close to the finish line and then you just can't align on the actual valuation? How often does that kill a deal? How hard a line do you have to draw in that regard?
We're usually having that discussion right away. So we'll see the deal. The valuations are usually front and center, unless they say like they're looking for letting the market decide, in which case it's not an issue. But when we see that, we just kind of right away say, hey, look, like your company looks really interesting, but your valuation is way outside what we would normally see for a business at this stage with your numbers. And then depending on how they respond to that, we either move forward or we don't. But unfortunately, that's something that comes out pretty early, and there are very standardized valuation, for lack of a better term, like formulas for these types of businesses, because it's such a heavy strategic purchasing sector. So who all have to be transparent about the valuations they're paying on these businesses. So the way that the enterprise value is calculated is somewhat standard. I mean, there's obviously not. It obviously moves depending on lots of factors, but it makes it easy to evaluate at that level pretty quickly.
Have there been any deals? Were there any deals that were so compelling that you were willing to sort of bend what you might normally do because of some other factor? Something about the business that was just so compelling, you felt like, we have to get in. We have to get in this.
Yes, but it always comes down to whether we think and how quickly we think they could grow into what will ultimately be a valuation formula that big strategics kind of set. And so, if it has a particularly compelling founder, or like maybe it's got like a big like influencer that carries their own market with them, or something where we feel like that the valuation today is high if you were just looking at today's numbers, but we have conviction that in 12 months it's going to blow past the valuation and we'll have grown into and then some. So we definitely do that occasionally as well. But ultimately what we're doing is making a predictive bet on whether that business will grow into a fair market valuation and how quickly.
We usually are pretty transparent with founders if it is a discussion on like why we're thinking the way we're thinking about valuation. And I like send people spreadsheets all the time. I'm like, this is the math we're doing. And it has to do a lot with your current revenue, your trailing 12-month revenue, your forward-looking revenue, as well as your growth profile and the margins of the business. And so we have different charts that we send over to people. And I think like usually making it a discussion makes it a lot easier throughout the diligence process. Then to your point, it's like we hardly ever like at the very end of diligence, and then it's a surprise that we can't get to the same place. We start those conversations really early.
I think the harder discussion on that front as an investor is in follow-on rounds where we're already in the business. And I think founders and a lot of investors always want it to be an up round, regardless of what the business is doing in terms of the fundamentals and the economics of the company. And so it as wanting to support founders that we're invested in with follow-on checks is an ongoing interest in something we think is important, but also not overpaying with new dollars is also something our investors are expecting and is important. And how do we reconcile those things with founders who have an emotional stake in not having down rounds? And so that can get, I think, much more complicated in general.
I want to get into follow-on rounds, but I'm interested before we do, I'm interested to hear about how you think about portfolio construction in general. I guess, how do you think about how to divide, let's say a $40 million fund? How do you think about how to divide that money up? Do you have a target number of deals you want to make, target check size? How do you think about differentiation among the companies that you're investing in? So let's use this hypothetical. You put money into my pretzel company. Does that change?
Josh, are you starting a pretzel company? Is that kind of where this is all leading?
This is the long game. It's just I'm trying to pitch you on my pretzel. No, I just love pretzels. No, but just I'm curious, like, are you now not going to invest in another pretzel company that comes along? I don't know how often you see pretzel companies, but I'm just curious about how you think about, differentiation within the portfolio and just the construction generally.
We try to be on like category wise, we try to be pretty mindful of competitors. So we really don't, especially in the same fund, like if you were starting a protein pretzel business, like we definitely wouldn't invest in another protein pretzel business within the same fund, probably across funds. Say general portfolio split, it's like 50% food and bev, 25% wellness supplements, 25% beauty, pet, other. It's kind of generally where our portfolio has shaken out. But I mean, branded consumer products is the overall focus. On companies in the portfolio, 20 to 25 is the goal. From how well we can manage them, with Genevieve and Dan sitting on boards, which they don't sit on boards for every company, but they sit on a number of boards. So being able to be value add partners is really important to our team. And so, having a manageable portfolio size is part of that. And with our check size and kind of where we come in, there's a lot of math. I don't know if Dan wants to dive into more of the portfolio construction math on, if we're writing $1 to $1.5 million checks on average, how many brands are we investing in, especially if we're reserving capital to follow on. And so that's where the 20 to 25 brands kind of shakes out.
Anything to add, Dan?
No, I think Mollye nailed it. The only maybe colors what we would probably do in practice is if you pitched us a pretzel snack brand, and then we said, well, in our first fund, we are an investor in FitJoy. So why don't we reach out to Norm and see what he thinks about this company and whether he feels like this is going to create a business problem for him if we made another investment in this general space, or maybe he's thinking like, oh, actually we're getting out of that category, or I don't know. But we typically will have a conversation about it with anyone on our side that we think would have something to add to the conversation.
We should get Norm on and see what he thinks.
Yeah, for sure. He could give you some ideas for new flavors for your pretzel brand.
I'll take all the help I can get. I'm going to read the next question verbatim, which I don't like to do, but I really like how this one's written. So bear with me as I actually read off the sheet. Suppose 3 portfolio companies need capital at the same time. One is dramatically outperforming and needs money to finance inventory for a major retail rollout. One is roughly on plan and raising another round, so investing would let you protect your ownership. And the third has missed its plan, but believes one more check gets it to profitability. You can only fund 2 of them. How do you decide where that follow-on capital goes? So if you want to use that specific example, I'd love to, but if you want to also just talk through how you think about follow-on rounds, and you're working with limited resources, right? So just the trade-offs that come along with follow-on rounds in general, I'd be really interested to dig into that.
Yeah. So the way we try to think about it, and I'll add one more complexity to your scenario, which is that the total amount of capital that we have for follow-ons is limited per fund. And so not only is there a question if we had 3 companies coming to us for money today, but we would also have to think about all the other companies in the portfolio who might need money between now and our investment horizon. Because if we invest today, that means we won't have that check to invest in some other company tomorrow. So it's also not about choosing between what's in front of us. It's about thinking of the entire follow-on capital pool as a whole. And what our investors expect us to do is to evaluate the current and future hypothetical investment follow-on choices and only do the ones that provide the highest multiple and IRR for them. And so what that means is not necessarily that if it's an existential check for someone, that automatically is going to make that check more important. And there's some judgment weightings in there about probability of success and probability of multiples growth over time, and also the essentiality of our capital, maybe to the extent that it's in one of the riskier follow-ons. But that's how we would try to be thinking about it. Is we'd probably model it out, and we would take the current 3 and what we think that the capital would provide in terms of a return, and also compare that to future potential checks that aren't on the table today, but that we think could be tomorrow.
I think one interesting thing that Dan said maybe a year or so ago that I hadn't really thought about as I'm learning the investor landscape is, putting Springdale's capital and time into our best performing brands. If you're thinking about what is the best return for our investors, the Power Law and Venture would say that we should really be allocating time and resources to the brands that as all of our brands in our portfolio scale, there'll be some winners, some that might not return very much, some that might return nothing. how do we make sure that we are guaranteeing the best outcomes in those super high performing brands? And so if the dollars make a huge difference in a, tremendous outcome, like that might be a better opportunity than preventing a one from going to a zero. If it takes a 3x to a 15x, for the portfolio.
Yeah. So when I think about technology venture investing versus consumer venture investing, I think about how there's sort of this desire to achieve like a massive, massive, massive multi-bagger when you're talking about investing in software, for example. And I don't think that's quite as common in this space. And so I'm wondering how you think about weighing, is that another sort of like filtration mechanism? Like, does every single company you see need to have the potential to be a 10 bagger? Or are you comfortable saying this is a safer bet because of XYZ criteria, but it's probably got a little bit of limited upside? Like, how do you think about that trade-off?
Well, I'll say what I think our diligence process is. Typically, we do want to underwrite at the beginning to a 10x. And so, like, is there a realm of possibility based on the category size, comps in the category, the strategic landscape, and the valuation at which we're investing that we believe we could 10x our investment? That said, to your point, like, most companies in CPG aren't going public. They're mostly getting acquired by strategics, but we still do believe that a 10x is very possible. Because of the stage we come in, like, we don't typically say like, oh, this will be fine if it's only a 2 or a 3. Like, we are still taking a pretty big risk as early stage investors at $1 to $10 million revenue businesses. So we try to hold ourselves to the 10x. But Dan, I don't know if you have anything you want to add.
Yeah, I think I think that's right, and I think that ultimately it's all backed into from the end result of, say, the fund trying to return a 3x to investors, and we know that not every company is going to make it. If we underwrote only to 3x for every company we invested in, and then you would absolutely never hit that goal. And so, because you have some that don't return at all, or return 1x or 2x, and that will pull the average down. And so it requires an underwriting of a larger multiple in order to end up where we want for the portfolio as a whole.
That makes complete sense. This space feels really noisy right now. Does it feel really noisy to you both as well? Or is it just sort of an effect of social media and things being hyper present now?
It's definitely noisy, but that's because there's so much opportunity in it and companies do so well in it, and it attracts a lot of entrepreneurs. And I think we see the same thing in any investment category, that like you see it right now also in AI, for example, to use your tech kind of parallel. And whenever there's brands growing and getting acquired and having big exits and being really successful, people flock to that space. So we see it not only in CPG as a whole, but even within CPG, something will kind of catch fire, and then that subsector becomes extremely noisy, like protein, for example. I think Mollye mentioned earlier, or fiber. And so what we're always trying to do, and one of the reasons that we really like the stage that we invest in, is that it allows us to look at companies that are a little bit past that noisiest part of the competitive landscape, where we can already see how quickly it's flying off the shelf, and what the margins are, and how successful that they're being in growth, their growth strategies and channel marketing and trade spend and things like that. And at that stage, the playing field is much, much, much less noisy. But I think if you just kind of were to take a survey of every company launching in CPG, I think noisy is a great adjective. I think if you were to look at what makes it past phase 3 of our funnel process, and it doesn't look as noisy anymore.
I think the other question that I feel like people ask me about my job a lot is like, oh, isn't CPG too crowded? Like, why do we need more things? And like, well, yeah, but like, people still love brands that speak to them, and like, there are new things being launched all the time. That it's not like we needed a new version of X, Y, or Z, but brand and community can get people really excited to switch from whatever they were using before. And so we think about both, innovation in a category that already exists, and maybe it's something that's a little bit better than the incumbents or something, a new ingredient in a product that already existed. Or, there is category creation still, and that can make us a little nervous sometimes too. Like, not everything needs to be completely novel. And honestly, we don't see that much that's like completely novel. You've never heard of this CPG item before, or creating a new category in the grocery store. But I always laugh when I get that question. So I'm like, well, yeah, like, you've been to the store, like, you've been to Target. Of course it's crowded. Like, that's how retail works. But I think there's still tons of opportunity to innovate and create amazing brands that are getting acquired despite companies already owning products in said portfolios.
Yeah, so I think to answer what the question I think you're probably really asking, Josh, is that you absolutely there's still white space in the pretzel snack category for you.
I think this is what I'm hearing. I think I should go into the sort of protein pretzel category and drop the show and just focus on building this brand that I've been, moonlighting on top of my existing moonlighting. Anyway, so let's use that example again. I was not planning on using this example so many times or at all, but the topic of protein keeps coming up, and I think it's really interesting, the idea of trends and what has staying power and what doesn't. So yeah, let's say I'm working on a protein pretzel company. Like, is that exciting at this point in 2026? There's a lot of protein products out there, and I think people are maybe getting a little tired of them, but maybe this is a trend that's going to stick around for a long time. So you can comment on protein specifically or not, but how do you think about the staying power that trends have, and what's a flash in the pan versus something that is worth putting money in?
It's a great question. Some things that seem like trends end up lasting a long time. And I think there's a few, ways to look at it. I think, one is certainly to say, okay, well, what's the underlying function or movement happening here? Is it, and what broader trend is it applicable to? And what do we think about that? So for example, when we think about protein, it's part of a much larger trend around longevity and finding ways to get more function into the things that we're putting in our body, where you might lump things like magnesium and other supplements and things into that same category that are driven by the health industry or by influencers like Peter Attia and others who have kind of created this idea in people's mind that their body's this machine, and in order for it to stay healthy, it needs certain ingredients and that in certain quantities. And so they're starting to think like, the healthy amount of protein based off these studies is, X grams per pound of body weight. And I can't eat that much meat. So how do I get more protein? Like there's a lot behind some of these trends. And then sometimes there's not. And so I think like we really try to identify what do we think is the cause beneath the new trend or the new branding direction that consumers are asking for, and then base it as best as we can on that. And then the other way we do it is by constructing a portfolio so that we are not overly concentrated in any one particular thing, which is an advantage that we have versus just if you were only making one direct investment, you're going to have a lot more concentration risk than across 25 investments. And so we think about it from both sides of like how much of a fad type trend versus a long lasting type trend do we think this is? And then also, what does that mean on a portfolio construction level? We're not going to invest in only plus protein types of products with, here's an ice cream and here's a pretzel and here's we definitely don't want to do that.
Yeah, the only other thing I'll say is for food and beverage, we still focus a lot on taste and convenience. So I guess that goes for supplements too. But anything that's too difficult for people to do all the time and doesn't taste good. That said, there are still companies that grow that don't taste very good, but that's usually a focus of ours in addition to whatever health trend or functional ingredient is a part of the product.
So I've heard Springdale referred to as operator-led a number of times. And, I've heard you all refer to the role that you play beyond just capital in terms of helping with decision-making and hiring and manufacturing and so on and so forth, right? Like there's a lot more that you do beyond just providing capital. You alluded to sitting on on numerous boards earlier in the discussion. I'm interested if you could walk me through an example. You can include the company name or not, but an example where a piece of advice or a situation that you stepped into materially changed a decision that a company was making, or even the trajectory of the company. Yeah, just curious to hear more about that sort of role that you play.
Yeah, I think, starting a business and operating one, especially as it's growing from 1 to 2 employees to 50 or 100 is really hard. And at that point, you're kind of navigating 10 different businesses across that journey because it's a very different company at 100 employees than at 2. And it's also extremely lonely. And a lot of investors who are at the table have never done that before. And they, not to any fault of their own, but the advice and the ideas that they have are without that context. And so, a lot of like making comments about how to manage a manufacturing team or how to think about the growth marketing spend as it relates to the overall EBITDA and financials of the company is very arm's length types of justifications for some of the recommendations being made, and that makes it challenging for the entrepreneur to figure out how to navigate the growth of the business while kind of addressing those sorts of observations and concerns. And so at the same time, like I would say probably a third of my time is spent almost more in like a shoulder to cry on quasi therapy type of role, just because it's really tough. And what do you do when 3 of your senior people quit all in the same day? And how do you handle it when your co-manufacturer completely botches a huge job and you lose your biggest account? Or what do you do when you have a really challenging HR issue pop up and you suddenly are looking at some kind of lawsuit from one of your ex-employees, or like any number of things that are, I think, really critical, extremely emotional, and extremely stressful, but also the kind of thing that it's really hard to find someone to talk to about unless you have people around the table who have been in that position before that can chat and relate, or even sometimes step in, like you mentioned, interviewing and finding new candidates is a great example. And we participate in those kinds of interviews a lot, or just being able to roll up our sleeves as needed, either whether that's just like as a thought experiment or intellectually, or actually kind of doing some work, being able to provide that bit of a psychological and emotional safety net for the founder, and someone who they know is at least shares and has their back from a shared perspective based on experiences is I think really valuable, and something that when we're talking to founders about investing comes through loud and clear from them to us, that's something that they value and have been looking for, and maybe even in often cases missing from their current board or their current investor group.
I'm not sure if this is something that you tease out as part of the diligence process. Do you find that there are a lot of cases where the entrepreneurs whose businesses you've invested in are not coming to you maybe as much as you'd like or at all? And if so, I'm interested to hear about maybe the success rate of companies whose founders are really leveraging your expertise versus those that are leveraging it less or not at all. I don't know if that's common, but yeah. I'm curious if there's a distinction there.
Yeah, I mean, we'd see it as our job to make sure that they know we're here. And so there's, I would say, a good amount of like proactive work that we make sure that we're doing to, I mean, it's easy if you're on the board because there's a cadence built in already, but otherwise, the regular outreach, just even if it's just to say like, hey, how are things going? Anything you want a thought partner on, because if you're running a business, you get really busy. Sometimes you don't want to bother. You kind of have a mentality of not wanting to bother other people with questions, stuff like that. Versus if you have a built-in cadence, it's very easy to say, "Oh, actually, I did have one thing I've been struggling with that'd be great to get your thoughts on." That maybe wouldn't have risen in your mind to that level of like, "Oh, I'm going to call Dan or I'm going to call Mollye and ask him about this." And so that's where we think of it. And then beyond that, it's very much our perspective is like, how do we just remove obstacles so that the founders can run their business and do what they do best. And we're not trying to invent things to work on for them and get in their way and ask them for a bunch of stuff that they're not already producing. unless we get the sense that something's really going wrong in the business, which is rare, I think we definitely see ourselves as a resource and a facilitator.
What's something that you've changed your mind about since either starting Springdale or joining Springdale?
I don't know, Molly, you may have a different answer than me, but I would say we're much more cautious around, and I guess skeptical around co-CEO types of roles. That's been kind of a repeated challenge, I would say. And there's some that do a great work in that dynamic, but more often than not, it ends up causing issues. So that's something that I think that we've learned along the way. I don't know, Molly, what would your answer be?
I think mine would probably be, and this isn't always the case, but we spend a lot of time talking to founders about the financials of their business. And I think when I started at Springdale, I was a little more like, oh, it's okay if the founder doesn't have a great handle on their financials because they can always hire an amazing finance team or fractional finance team. I would say I feel more strongly now that for the most part, the best founders that we both due diligence on and end up investing in have a really great handle on their financials and what drives their business forward. And so for me, it's been a really big learning on just like questions to ask during diligence and how to think about that part of the business, because it really is like a testament to the founders that we end up backing, the ones that like you can tell when you're talking to them right away, like they know every metric inside and out. So that's just been like kind of a interesting for me as an investor learning, I think, during the diligence process.
I think we have time for one more question. Do you have a single universally applicable piece of advice that you could give for any founders listening to this episode?
And mine would be, and I know this is like an annoying one, I feel like I've probably said it before, but like I love meeting people. And so even if I reply to an email and say like, it's not the right time right now, like getting on people's radar early is great. And like my email inbox, I'm always like, oh, like I love that this founder reached out. So I think like building the network, and I try to do the same the other direction of if I see something cool on Instagram or TikTok, like reaching out to the founder just to say hello. I think building the network early is always my advice on the fundraising side.
That's super similar to mine. So now I'm trying to think of a different one. Mine was going to be networking. I think meeting other founders, peers, other CEOs, meeting investors, meeting executives in the space. It helps with fundraising, helps with hiring, helps with best practices, helps with new product ideas. It helps with like every possible thing you can imagine. And most people are horrible at it. And I think so hyper networking would be by far my number one. And then I guess my cheesy answer is know your unit economics. We talk to a lot of founders that they get fixated, I'd say mostly on gross margin, and then they completely forget about everything else in terms of pitching the growth opportunity that they have in front of them in terms of like acquisition cost or trade spend or whatever it is. And so really understand the unit economics of the business and where it can go and why. Because I mean, a lot of times if you're only making small runs of products, your unit economics might not be great, but at volume or at scale, where is it going to get to and why, and really understanding that journey.
That might be the most apt answer I've received to any question on this particular show. So thank you.
I was going to say finance thing, but that was the answer to my last question. So I was like, I'll do something a little more interpersonal than contribution margin.
Mollye and Dan, thank you both so much for the time. I really
Thanks,
appreciate
Josh.
it. Yeah, absolutely. If you want to share with listeners where they can find Springdale, please feel free to do so.
Yeah, our website has a form that all of it goes to me. So you're getting to me either way if you fill out that form on our website. And LinkedIn, we're always on there.
Amazing. Thank you again. All right, let's debrief. I think what stood out to me most in this conversation is just how many different criteria have to be met in order for a consumer business to actually make sense as a venture investment. It's not enough to just have strong growth or good margins in isolation. Springdale's looking at how those things interact with the founder, the valuation, the size of the opportunity, and ultimately the return the business could generate. I also really appreciated the discussion around follow-on investing. The idea of putting more capital behind a company that's already winning being a better use of money than trying to save one that's struggling is obvious once you hear it explained, but it gave me a much better understanding of how investors have to think at the portfolio level. Again, I learned so much during my conversation with Mollye and Dan, and I hope you enjoyed it as much as I did. If you haven't already, make sure to follow and leave a review wherever you get your podcasts. Thanks for listening.